We just finished going through ASML's calendar 2026 second quarter earnings materials, and now we want to share our takeaways with everyone. Let me start with what everybody's already saying. ASML is the perfect monopoly, the one company printing the entire AI era, can't lose. And you know what? They're mostly right, and that's the annoying part. But here's the thing that keeps me up at night. When a stock is this loved and this expensive, perfect isn't good enough. You need perfect forever. So, today we're not asking is ASML a great business? Obviously it is. We're asking the harder question, is all of that greatness already sitting in the price? Let's put the headline numbers on the table first because they are frankly absurd in a good way. The company reported second quarter revenue of 9.3 billion euros, a gross margin of 54% and net income of 2.9 billion euros. Read that margin again, 54% on machines the size of a bus. That is software company profitability on industrial hardware. But the number that actually made me sit up isn't on the income statement, it's the order book. The filing says the order book is effectively full through 2027, and there are already massive extreme ultraviolet batches locked in for 2028. Think about what that means. Most companies can barely see 2 quarters out. ASML can see 2 years out. Now, to be fair, a full order book is a promise, not cash in the bank, and we'll test that promise later. But as a starting hand, this is about as strong as a company can be dealt. Let me teach you the actual business, because the Moat only makes sense once you see what they make. Every advanced chip in the world, the ones running AI, gets its finest features printed by an ASML lithography machine at a scale measured in nanometers. The company groups the money into 3 buckets. 1. Machine sales, the big EUV and immersion tools, high-ticket explosive, lumpy capital revenue. 2. Installed base upgrades and services, software and hardware retrofits on machines already out in the field. And this one is recurring and compounding. 3. Metrology and inspection, the tools that tell a fab whether its chips are any good. And then there's the frontier high-end EUV, which the deck calls the absolute monopoly standard for every future advanced node. Here's my read. Most people only watch bucket 1, the shiny new machines. The real story, the one that survives a downturn, is bucket 2, and we'll get there. Now here's the part that makes an old value guy genuinely happy, because it's the razor and the blades all over again. Engine 1 is hardware. They sell a machine, and the deck calls it explosive capital, huge unit economics, big top line bursts, but it comes in waves. Engine 2 is the installed base, and this is the quiet compounding annuity. Every machine they've ever shipped is still out there, and as that global base grows, the high margin service revenue scales right along with it, almost on autopilot. Here's the margin secret the company points to. A lot of these upgrades are pure software. Think about that economics. The customer gets 0 downtime and an instant productivity jump, and ASML ships it at near 0 cost. You sell a line of code that makes a 200 million euro machine faster, and you keep almost all of it. That's the engine sitting underneath the 54% margin, and it is a beautiful thing to own. Alright, a beat is a beat, but not all beats are created equal, so let's do the autopsy. Revenue hit 9.3 billion euros at that 54% margin, and the company notes it absorbed embedded IT and tech transformation costs while doing it. But here's the unsung hero of the quarter. The installed base segment came in at 2.8 billion euros, beating what the street expected. And why did it beat? The deck says it was driven entirely by clients rushing to upgrade the systems they already own. That is a very different animal from just selling more new machines. Management pins the fat margin on 3 things: a richer upgrade mix, which is basically pure profit software, more volume to spread the fixed costs over, and a favorable blend of EUV and immersion sales. Here's my take, and I don't think it's controversial. A beat powered by high-margin software and services is worth a lot more than a beat powered by a hardware cycle that can turn. The quality of earnings here is high. Now, they didn't just beat, they raised, and the shape of the raise is what matters. The company put a full year 2026 target on the board, 43 to 45 billion euros of revenue at a 54 to 56% margin, with a big step up in the third quarter to 11 to 12 billion in a single quarter. But look at how the growth is spread, because this is the tell. Memory guided up 75%, EUV up 45%, upgrades and services up more than 30, up 25%, metrology up 25%, every single segment up at the same time. Here's why the deck flags that, and I agree. Raising every operating line simultaneously is rare. It usually means management can genuinely see the orders, not just guess at them. The bull case says this is crystal clear visibility far beyond what most companies ever get. I'll grant that mostly, though I gently point out that guidance this clean and this bullish also sets a very high bar to clear. So where is all of this demand actually coming from? The deck splits it into two pipes, and normally these two don't fire at once. The first pipe is logic, the processors, and AI is forcing foundries to pile on capacity at 5, 4, and 3 nanometers. The 2 nanometer ramp is speeding up, and 1.4 nanometer is already being evaluated. The second pipe is memory, where the company points to severe shortages in standard memory and high bandwidth memory, and crucially, the newer memory nodes need far more lithography per chip than the old ones. Here's the phenomenon the deck names, and it's the heart of the bull case. Both pipes are accelerating at the same time. Logic and memory both point upstream to the exact same bottleneck, and that bottleneck is ASML. When both of your biggest customers hit the gas together, and they both have to come through your door, that is about as good as demand gets. The bears would say sure, but two engines revving at once can also stall at once. Hold that thought. Let's talk about the moat because everyone says monopoly, but let me show you how deep this one actually runs. The big milestone this quarter, management confirmed that Intel has successfully put high NA-EUV, the next generation machine, into high volume manufacturing. That matters because it flips high NA from a science project into a proven working tool. The deck says it decisively proves the maturity. And here's the game theory reality the company is basically living. There are zero alternative suppliers for advanced EUV, none. So the foundries, even giants like TSMC and Samsung, have no leverage. They don't negotiate, they queue up. The deck puts it bluntly, ASL isn't just supplying the market anymore. It's dictating the adoption timeline to the rest of the world. I have to be honest with you as a moat. This is about as close to unbreakable as I have ever seen in any industry. This is the green part of the story, and it's genuinely, structurally green. The catch is never the moat, it's the price you pay for it. Now, I want to come back to that second engine because it's the answer to the single biggest worry about this stock. The worry is simple. Machine sales are lumpy and cyclical. They spike and they crater. But look at what the installed base does underneath all that noise. It just grows smoothly more than 30% year over year. The deck breaks it into two pieces. Upgrades, which are pure software and efficiency boosts that give the customer instant payback. And services, which is mandatory recurring revenue tied directly to every active machine out in the field. Here's the strategic point, and it's a strong one. This segment is a structural insurance policy. When new orders get volatile, and someday they will, this compounding, high-margin annuity keeps the overall profitability from cratering along with them. So the bull case isn't just AI is booming. It's even when AI stops booming, this flow holds. That's a genuinely important piece, and I'd weight it heavily on the positive side of the ledger. Okay, here's where I start earning my keep as a referee because this slide has two faces. Phase 1, the good one, the 2027 order book isn't just full, it's full of hard, signed, long-term contracts, not casual verbal estimates, and 2028 already has big batches locked in. But Phase 2 is the one the crowd keeps skipping right past. To deliver all of that, the company plans to expand EUV capacity by 30% in 2027, and then another 30% in 2028, with immersion capacity ramping to match. Do that math, that's compounding a 30% physical build out 2 years running. And the deck is refreshingly honest here. It says the financial visibility is flawless, but the physical execution is a completely separate reality. Building that many of the most complex machines ever made, 2 years straight, without the supply chain hiccuping, that is a real risk. My read, the orders are the easy part now. The hard part is the factory floor, and that's exactly where I'd watch for the first crack. Now this slide I love, because it's the deck being honest about its own sources. On one side, the management pitch and give them credit. The core claims hold up, execution looks flawless, the installed base really is a high margin engine, orders really are locked through 2028, and high NA really is yielding at Intel. The analyst view even admits it, the fundamental assertions are mathematically bulletproof, the monopoly is real. But here's the blind spot, and it is a big one. The company says this earnings update came as a highly controlled, in-house video, with guided questions and zero adversarial probing from independent analysts. Read that again, nobody in that room was trying to poke holes. So here's the mature takeaway. When a story is this polished and nobody tough got to push back, you have to discount the long-term claims a little. Not because they're lies, but because they were never stress tested against the macro risks. I trust the numbers they showed me. I'm just very aware of the questions nobody got to ask. Let's keep pulling that thread because what management chooses to talk about tells you as much as the numbers do. In the high transparency zone, they were generous. The CFO walked through that 300 million euro installed base beat in detail, eager to show off the service margins. The CEO rattled off exact segment growth, memory up 75%, logic up 25%, no hesitation, no hedging. When the news is good, this team is an open book. But now watch the low transparency zone, the stuff they glossed over. China, which the company itself pegs at about 20% of revenue, got waved through as just local logic demand, with basically nothing said about escalating geopolitical tension or export controls. And downside scenarios, what happens in a cyclical downturn, how they'd cushion it, essentially absent. Here's my honest read, this isn't lying, it's salesmanship, you lead with your best cards. But a 20% China exposure and zero downturn planning are exactly the two things I'd have pushed hard on, and nobody in that room did. Alright, this is the question the whole deck has been building toward. Can a flawless company still be a risky stock? Yes, it can, and here are the 4 reasons. Alert 1 valuation. The materials note the stock is up 110% over the last 12 months, sitting near its highs, priced for absolute perfection. That phrase should scare you a little. Perfection leaves zero room for a stumble. Alert 2, China, that 20% of revenue we just talked about. One export control headline and it is exposed. Alert 3, cyclicality, and this is the subtle one. Chips are always cyclical, and peak visibility today just builds a terrifyingly high baseline for the next downturn to fall from. Alert 4, execution, that compounding 30% capacity build we covered, while swallowing an internal IT overhaul at the same time. None of these say the company is bad, it's superb. They say the stock, at this price, has already priced in a future where absolutely nothing goes wrong. Let me put the whole debate on one table, because it clarifies what you're actually betting on. The core bet is this: you're tying long-term AI spending to a lithography monopoly that basically cannot be broken. To win, a few things have to go right. The AI capacity expansion executes cleanly, 2 nanometer and high, NA ramps smoothly, the service annuity keeps compounding, they hit that 45 billion euro target, and the monopoly stays untouched through 2028. To lose, notice something. Almost none of the losing conditions are about the company itself. AI capex gets delayed or rationalized, a sudden China policy triggers a revenue shock, or the plain old semiconductor cycle rolls over and erases all of this beautiful visibility. That's the whole point, and the deck says it plainly. The fundamentals are pristine and the moats are deep. So at these prices, you are not betting on company quality. That part is settled. You are betting on execution and the macro cycle. That's a very different bet, and you should know exactly which one you're making. Last slide, and it's the most useful. The company hands you the exact dashboard to grade them by 7 gauges. 1, revenue trajectory. Are they pacing to that 43 to 45 billion full year number, which means hitting 11 to 12 billion in the third quarter? 2, the installed base. Does it hold that crucial 2.9 billion per quarter run rate floor? 3, gross margins. Do they defend the 54 to 56% floor against those IT and transformation costs? 4, segment growth. Do the aggressive lines actually show up? Memory up 75% and EUV up 4-5%. 5, order visibility. Does the 2027 and 2028 book hold firm with 0 high profile cancellations? Watch that word, cancellations. 6, high NA diffusion. Does adoption spread beyond Intel to the other foundries? And 7, China. Does that 20% hold? And watch for any sign at all of AI spending cooling off. Print this list, tape it to your monitor, and the quarter any of these starts slipping, you'll know before the crowd does. Alright, last thing, radar always leaves you a light. I'm weighing all of it, and let me be crystal clear about what I'm weighing on the business. This is an A+, a genuine monopoly, a compounding annuity, 54% margins, and a moat I'd call close to unbreakable. If this were purely a question about company quality, it's a green all day long. But the light isn't about the business, it's about the business at this price. And at up 110% in 12 months, priced for absolute perfection, at what looks like a cyclical peak, with 20% of revenue sitting in China and an earnings format where nobody got to ask a hard question. I'm calling this one red. Not because it's bad, it is the opposite of bad, but because at this price the reward simply doesn't pay you for the risk, so I'd step aside and wait. Here's what flips me to green, and I'm telling you this up front. Give me a real cyclical pullback that compresses this multiple, or a couple more quarters proving that annuity holds through a downturn, and I'll happily turn this light green and admit the wait was worth it. And what keeps it red? Another leg up on the same perfect forever story, because that just makes the risk worse, not better. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.